Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster. Today is April 6, 2026. This is your weekly market insights. We'll review last week and then also touch on some things going on this week and what's in hold for the stock market. So stocks on the rise on hopes of Middle East calm. That was the headline for last week. Stocks rose over the short trading week on fresh hopes for a quick end to the Middle East conflict, while March job growth was unexpectedly strong. The S&P 500 index picked up 3.3%. The climb represented the S&P 500's first weekly gain since the week ended February 20th. The S&P 500 ended Thursday's session, the last of the shortened week, at 6,582.69. The U.S. stock market was closed for Good Friday. The index on Tuesday ended March with a drop of 5.1%, the largest monthly percentage decline in a year that resulted in a Q1 loss of about 4.6%. That marked the index's first quarterly decline in a year. The March slide came as the U.S.-Israel war with Iran contributed to market uncertainty and a surge in oil prices. The NASDAQ Composite Index gained 4.44%. That's the tech-heavy index, that is. The Dow Jones Industrial Average added 2.96%. So that's the Dow 30. And the MSCI EFA Index, which tracks developed overseas stock markets, advanced 2.59% over the 4 trading days through last Thursday. So stocks rebound. With the war having reached its 1-month mark, investors are looking for a hope it may be nearing its end. Late Wednesday, U.S. President Donald Trump said the U.S. was close to achieving its military objectives. However, he also said the U.S. would hit Iran, quote, extremely hard over the next 2 to 3 weeks, end quote. Tehran, in response, warned of a more crushing blow, CNN reported. The communication services sector had the largest weekly percentage gain, climbing 6.4%, followed by a 4.6% climb in technology. Real estate, financials, and materials were also strong, rising more than 3% each, while industrials, consumer discretionary, and healthcare added more than 2% each. Utilities and consumer staples also edged higher. Facebook parent Meta Platforms was among the top gainers in communication services, rising 9.3%. The company introduced its first artificial intelligence glasses with prescription lenses alongside several upcoming software enhancements. Intel was one of the best performers in tech sector, jumping 17%. The company and Apollo Global Management, ticker symbol APO, said they reached a deal under which Intel will buy back for $14.20 billion the 49% stake in the joint venture related to its Fab 34 plant in Ireland that it previously sold to Apollo. Intel expects the transaction to boost ongoing earnings per share and to support its credit profile in 2027 and beyond. And it also adds liquidity to Apollo Global Management. Energy was the lone decliner for the week, shedding 5.3%. Expand Energy was one of the hardest hit stocks, falling 8.5% for the week. The company's stock was downgraded by KeyBank to sector weight from overweight in a note to clients. KeyBank analysts said its management uncertainty has disappointed investors following the departures of both the company's chief financial officer and chief executive officer in the last 8 months. In other news, SpaceX is preparing to go public, having submitted a confidential draft registration for initial stock offering, or IPO, to the U.S. Securities Exchange Commission. According to people familiar with the process, if completed, the listing could also happen as soon as June with a valuation that may exceed $1.75 trillion, raising between $50 billion to $75 billion, according to the Bloomberg article release. It's also out there on wide charts. It's all over the news, actually, if you look it up. Charts of the week. So AI related industry performance price return. This chart shows the annual performance since 2023 of several parts of the market related to AI. The table adds each industry's weight in the S&P 500 as well as its forward valuation. Thank you, JP Morgan Asset Management and Guide to the Markets for releasing that. You guys do excellent work. I like posting your charts. I put that out on the blog, so go check it out. Essentially, you're seeing the hyperscalers, the semis, hardware, software, power, metals and mining, and then the S&P 500 equal weight as a barometer. And you're looking at also on the chart, you'll see that the price to earnings multiples are all listed on there. Hyperscalers are around 22.3 times, semiconductors 19.4 times, hardware is 25.7 times, software 21.3, power 23.1, metals and mining 13.5, and then the equal weight's around 16 times. And you'll see that information out there. Thank you, FactSet, for a lot of that data within JP Morgan's chart. Value versus growth, earnings, performance, and valuation. So the chart on the blog shows year-over-year earnings growth of the S&P 500 sectors, with value-dominated sectors in gray and growth sectors in green. Tech is in the lead, but several value sectors also offer EPS growth above the index. Similarly, the chart also, which has kind of three charts within it, shows that the best performing companies are spread out across sectors and styles, which also is a catalyst for having diversification within your portfolio and not just focusing on one space in a portfolio. Lastly, the chart on the very bottom right highlights the Russell 1000 value, what it's trading at a significant discount to the Russell 1000 growth indexes. So you can kind of take a look at that. There's opportunities in the mid cap and small cap space, but you also take on more risk or more beta when you do that. So allocate appropriately. And if you have questions around your portfolio allocations, as there's been a lot of stuff happen in 2026, feel free to reach out to Northbound Wealth Management. We'd be happy to review your portfolio and give you some insight as we go forward throughout 2026. So weekly market insights. Thank you, Y Charts, for this data. Let's see. We're NASDAQ's. We'll just review all the indexes. S&P 500's down about 3.5%, 4%. Dow is down around 3%. MSCI is down, or is actually up 1.5% or flat. And then the NASDAQ's down about 5.71%. The 10-year Treasury notes trading around 4.31. That is up about 6.42% from a month ago. All right. Jobs update. U.S. stock markets were closed Friday, but investors were on the lookout for the March jobs report. Employers added 178,000 jobs in March, an unexpected increase that marked the best month in over a year. Economists expected a gain of around 59,000 jobs. Unemployment fell to 4.3% from 4.4% in February. So the economy and the labor market seems to be holding in there. This week, key economic data, durable goods, Tuesday. Chicago Fed President Austin Goolsbee speaks, and then consumer credit reports. We'll see what that February number looks like. Wednesday, FOMC, March meeting minutes released. Thursday, personal consumption expenditures, or the PCE index for February, that is. Okay, so it's a lagging indicator. We're going to be tracking that. Q4 gross domestic product, second revision, weekly jobless claims, wholesale inventories for February data. Friday, consumer price index, which is CPI, factory orders, consumer sentiment. So there's some inflation measurements that we'll get. And then notable companies reporting earnings. Wednesday, Delta Airlines, ticker symbol DAL, is reporting. That's the main one. But what we're going to be looking forward to is not this week, but next week, when we kick off Q1 2026 earnings reports with the large banks, starting with like JP Morgan, Bank of America, Wells Fargo, companies like that. All right, keep these tips in mind when selling a home. This is your tax tip of the week. If you're selling your home, you may be able to exclude the sales capital gain from your tax return. The first thing to consider is the home's ownership and use. To claim the exclusion, you must have owned the house and used it as your primary residence for at least 2 years. If you're selling your main home, you can exclude up to $250,000 of capital gain for single filers and up to $500,000 gain for joint filers from your return. If you own more than one home, you can exclude only the gains on selling your primary home. However, the loss is generally not deductible if you sell your home at a loss. You can also choose not to claim the exclusion, in which case you must report the gain on your tax return. Some taxpayers must also report forgiven or canceled debt as income on their tax return, including debt forgiven or canceled through foreclosure or other processes in which a lender cancels mortgage debt on the home. This information is not a substitute for individualized tax advice. Please consult with a qualified tax professional to discuss your specific tax issues. This tip was adapted from irs.gov. All right. We're going to dive into a lot more in this iteration. Stay tuned for the next segment. Hey, everybody. I hope that your weekend was wonderful. I pray that it brought peace and renewal and a reminder of what matters most over the Easter holiday. And just want to give thanks to our Lord and Savior for providing a path to God, and just appreciate being able to share that openly and freely here in America. And just having a faith perspective is always a good thing. It adds value to life, and it aligns our relationship with other people and with the community around us. We're all in this thing together. So hopefully you had a great weekend and celebrated the holiday in great shape with family and reflecting on what God has done. All right, get this. Investors working with financial professionals are about half as likely to report high financial stress. That was a source article from Vanguard 2025, and that gap makes sense. April is National Stress Awareness Month, and the American Psychological Association has already found that money is the source of stress for many Americans. That's no surprise. Do any of these questions worry you? First, do I have enough for retirement? The type of retirement I've imagined. Do we have enough support? Parents or other family members? Do we have enough to support parents or other family members in need? And then what if the market gets choppy? Well, that's already happened. It's going on right now. Clarity does not eliminate uncertainty, but it can help manage the mental load. CFP board research from 2025 also points the same direction. 49% of CFP clients reported less financial anxiety through an advised relationship. A good strategy does not promise outcomes. It replaces worry with decisions, and decisions with a process that holds up when life changes. So if you have questions on whether or not you have enough or have enough for retirement that you want to live, feel free to reach out to us here at Northbound. We'll be happy to help you. Hey everyone, there's 9 days until tax day. A busy person like you might find themselves filing your taxes in the final stretch for many reasons. Don't sweat it. Get your paperwork together, talk to your trusted tax professionals, and remember that filing for an extension is possible before April 15th. All right. 5 ways Americans overpay in taxes. A quick look at common situations where people may end up paying more than they need to. Number 1, selling investments too soon. Profits from investments held for less than a year are considered short-term capital gains and taxed as ordinary income. Holding an investment for more than a year may qualify for long-term capital gains treatment. That's according to Bankrate, July 2025, and it is true. For example, if you hold a stock for 12 months and a day and sell it, then you're paying a lower effective tax rate, hypothetically, than you would if you sold it within 12 months. All right. Number 2, not using your tax advantage. What does that mean? Well, company-sponsored retirement plans help you save for retirement while offering some tax benefits. Contributions reduce taxable income today, which can help set you up for future success. Number 3, overlooking municipal bonds. Interest earned on many municipal bonds are exempt from federal income tax and sometimes from state and local taxes as well. Municipal bonds, as a reminder, carry various risks, including interest rate adjustments, call risk, market conditions, and default risk. So consider reviewing specifics with a qualified financial professional. Number 4, triggering unplanned capital gains in mutual funds. So exchange traded funds, or ETFs, generally give investors more control over when to realize capital gains or losses. Mutual funds, however, can distribute gains even if no shares are sold. And as a reminder, mutual funds and exchange traded funds are sold by prospectus. Please consider the charges, risks, expenses, and investment objectives carefully before investing. That's why here at Northbound Wealth Management, we employ the majority of the time exchange traded funds. Number 5, missing coordination between professionals. A financial professional and a qualified tax preparer can coordinate to help align investments and tax strategies. And those are the top 5 why refunds can be misleading. Roughly 3 in 4 Americans receive a refund each year, averaging about $3,000. That refund means taxes were overpaid throughout the year. Doesn't mean that it means the government basically got a free loan on your money. It's not about paying less, it's about paying what's right. Understanding how investments and tax rules interact can help you make more informed decisions. So there you go. 5 ways Americans overpay in taxes. We've all heard some wild takes on Social Security. Let's separate the myths from the facts, starting with the big one. People worry that Social Security may not be able to keep its commitment to retired Americans. The truth, benefits have always continued, and any changes can take years to kick in. Some think that a high income Social Security doesn't matter, but it can still play a role in nearly every retirement mix, regardless of your level of worth. There is a best age to claim. In reality, it depends on your situation. There's no one-size-fits-all solution with it. A lot of people think Social Security COLAs are the same each year. False. Costs of living adjustments are considered annually based on inflation. And finally, Social Security has plenty of myths, but the facts matter. Have questions about how Social Security fits into your financial strategy? Let's chat. You can give us a call at Northbound Wealth Management, 317-399-1107. So in Indiana, where I live, they're experiencing a significant data center boom, largely driven by demand for AI and cloud computing infrastructure. Major hyperscalers like Amazon, Meta, Microsoft, Google, and others are investing billions of dollars of projects announced under construction or in advanced planning stages across the state. As of early 2026, estimates suggest around 30 to 35 major projects, many hyperscale, that's the highest level, are active, adding substantial power capacity, potentially thousands of megawatts, though some face local opposition over energy use, water consumption, noise, and infrastructure strain. Here are the most prominent data centers being built, under construction or recently broken ground, or in late stage development. So major hyperscale projects: Amazon Web Services, Project Rainier, Newcastle, St. Joseph County near South Bend, a massive 1,200-acre campus with up to 30-plus buildings, initially planned for 16, so they expanded it. Originally announced as an $11 billion investment, additional $15 billion announced in late 2025 for further northern Indiana campuses, including potential sites like Hobart, Indiana, focused on AI training. Examples are supporting like Anthropic models. Construction is well underway with buildings rising and generators staged. Parts reported opened or accelerating towards 2026 operations. Significant power draw, over 2 gigawatt potential, and water use noted. Meta has a data center going in Lebanon, Boone County, Leap District, $10+ billion, 1 gigawatt campus on 1,500 acres with up to 13 buildings, including 10 data halls. Construction officially broke ground in February 2026. Meta's second major Indiana site expected online late 2027 or early 2028. Supports AI workloads. Meta has a data center going in Jeffersonville, Clark County, $800 million to $1 billion. Investments earlier reports about 700,000 square foot campus along the Ohio River. Construction underway or nearing completion, with expectations for 2026 operations. Meta's first Indiana data center. Microsoft has one going in LaPorte, Northwest Indiana Radius Industrial Park, $1 billion project for about 245,000 square foot facility on 489 acres, announced in 2024, under development as part of a broader Northern Indiana activity. Google has one going in Fort Wayne, Allen County. $2 billion data center broke ground earlier. Reports operational late 2025, 2026, includes significant backup power, dozens of diesel generators. Google has additional plans, such as in Morgan County as well. No other notable projects under construction or approved or in advanced planning: Sabi data centers in Decatur Township, that's southwest Indianapolis, Marion County. $4 billion investment, 130-acre two-building, 900,000 square feet campus near Canby Road and Kentucky Avenue, approved by local commission in March of 2026 after some community pushback. Metro Blocks, Martindale, Brightwood, that's northeast Indianapolis. Smaller scale proposal, about 154,000 square feet on a former drive-in site. Rezoning approved recently amid local opposition. Northern Indiana cluster, LaPorte County, Michigan City area. Kind of touched on some of those. There's even multiple smaller early stage projects. So not all the big hyperscalers, but other ones. It's Project Cardinal in LaPorte. Let's see, 110 acres, 5 buildings, and a site at 402 Royal Road in Michigan City. Part of reports noting about 8 to 11 data centers planned under construction in the region. Additional proposals include sites in Henry County near Knightstown, which was approved, Hancock County, a 775-acre mega site PUD by Surge Development, and various spots around Indianapolis and northwest Indiana. Smaller or co-location facilities exist and are expanding into markets like Indianapolis, with dozens of existing sites, South Bend and Fort Wayne. So the broader context is that Indiana has attracted these investments due to a relatively affordable land, tax incentives, available power through utilities like NIPSCO, I&M, and AES are planning major upgrades, and central location in the country, actually. It's a strategic location. Total announced investments from big tech exceeded 14 to 30 plus billion, when including expansions with hyperscale AI-focused campuses dominating recent growth. However, concerns include massive electricity demand, potentially tripling some utility loads, water usage, like shared aquifer access in New Carlisle, diesel backups, and limited permanent jobs relative to the scale of these things. Some projects are still in rezoning planning, not yet being built, and community, that's kind of like land banking, I guess, and community resistance has led to withdrawals and delays in certain areas. For the absolute latest statuses on specific sites, check local economic development sites like IEDC or utility findings, as timelines can shift rapidly. If you're interested in a particular region, like Northern Indiana versus Indianapolis area, power or water impacts or maps, there's a lot of sources out there for that. And I was pulling this information from Grok, and about 68 different sources that are feeding through into this compute. So it's interesting is I'm using AI and this trend is not going to stop. It's going to continue. It's going to be it's the build out of the next technological revolution, and the hyperscalers are the lead, and they are running full steam ahead and building out these major projects so that we can have compute power and power robotics and AI and all kinds of advancements in the future. All right, so I went over the Indiana data center boom and what's going on. Let's talk about what are the negatives of data centers and what's some of the pushback. So data centers, for those that don't know, which they basically power cloud computing, AI, streaming, and much of the modern digital economy, come with several significant downsides. These impacts have grown more pronounced with the rapid expansion by AI workloads, which demand far more resources than traditional facilities. Here are the main negatives based on environmental, social, and economic effects. I will say that I'm going to go over the negatives here, but then the next thing I'm going to go over are the positives. And from my point of view, I'll just say this up front. I think the positives outweigh the negatives by far, especially when we're in competition with other global powers like China, for example. It's something like this too. Why haven't we been able to build in the United States high-speed rail? Why can't we upgrade our infrastructure? Why can't we bring along also the rural communities? So there are legit concerns, but I think that over time this is going to be a net positive. Let's see, high energy consumption and grid strain. So data centers are extremely power hungry. A single modern AI focused hyperscale data center can consume as much electricity as 100,000 homes or more for the largest ones. Globally, data centers already account for a notable share of the electricity use, with projections showing consumption roughly double or triple in the coming years, potentially reaching hundreds of terawatt hours annually in the US alone. This surge strains power grids, contributes to high electricity demand growth, and can lead to increased risk of blackouts, delays in retiring fossil fuel plants, pressure to build new generation capacity. In many cases, a large portion of this energy still comes from fossil fuels, slowing clean energy transitions in some regions. So you've probably heard Elon Musk talk about SpaceX and then building data centers in space because it's going to be way more energy efficient out there. I don't know how exactly you do that, but I'm going to be looking into all of that. SpaceX is planning an IPO here soon anyway. It'll be interesting to see what they talk about as they move into the public eye and public markets. Also, would like to say that I don't like the idea of delays in retiring fossil fuel plants. Fossil fuel plants, frankly, China opens them up all the time and it's cheap energy. It's just, I think that the United States does a much better job on energy efficiency with fossil fuel plants. And we actually care about the environment, whereas some other countries do not. And so we don't exactly put out dirty carbon emissions from that, but people might disagree with me. Nuclear might be a really good option as well, which has gotten a lot of headlines to try to help with that, which is the pressure to build new generation capacity. And let's see, greenhouse gas emissions, that is one of the focuses. The electrical demand translates into what some say is substantial carbon emissions. Projects for AI-related data center growth suggest annual additions of tens of millions of metric tons of CO2 by 2030, equivalent to adding millions of cars to the roads. Even with grid decarbonization efforts, total emissions may rise if demand outpaces cleaner power sources. Backup diesel generators used during outages or peaks emit high levels of pollutants and can worsen this footprint. Massive water usage for cooling. So cooling servers requires enormous amounts of water, often through evaporative systems. A mid-sized facility might use hundreds of thousands of gallons a day, while larger ones can consume millions, comparable to the daily water usage of a small city. AI-driven growth is expected to drive U.S. data center water consumption into the billions of gallons annually. So maybe on the back end of this, there'll be innovations with reusing water, maybe on-site treatment plants for their own data centers. That'd be interesting. This creates problems in water-stressed areas, potentially depleting in local aquifers, wells, or reservoirs, especially during droughts. Some communities have reported reduced water availability for residents. Water is also used indirectly for power plant cooling. Air pollution and public health risks. Data centers contribute to air quality issues through grid electricity generation, often fossil-based, on-site gas turbines or diesel backups. Key pollutants include nitrogen oxides, fine particulate matter, and other links to respiratory diseases, asthma, cardiovascular problems, and high cancer risks. Don't we have that already across the country? Let's see. Studies project significant public health burdens, including hundreds of thousands of asthma and premature deaths annually in the U.S. by 2030, with associated costs in the billions of dollars. So There are some pieces and articles written out there talking about that. These impacts often fall disproportionately on nearby, frequently rural or lower income communities, raising environmental justice concerns. Noise and light pollution. Constant operations produce a loud hum from cooling systems, HVAC fans, generators sometimes exceeding 85 to 90 decibels, which can harm hearing and cause stress, sleep disruptions, headaches, and reduced quality for life of local residents. Construction adds temporary but intense noise. 24/7 lighting for security creates light pollution, disrupting human sleep cycles, melatonin suppression, and affecting wildlife behavior, migration, and habitats, which could lead to loss of habitats, reduced biodiversity, and need additional infrastructure like transmission lines. They can also create localized heat islands, raising nearby surface temperatures by several degrees on average, up to much higher extremes. So there's some land use and habitat disruption that comes with these, just like with any kind of manufacturing and development and expansion over raw land. Let's see, economic and community impacts, higher utility bills, limited local benefits, and waste. Public opinion in the US reflects these concerns, with surveys showing more people viewing data centers as harmful to the environment, energy costs, and nearby quality of life than beneficial. That's from Pew Research, actually, and we'll see how that trend continues, if it does or not, or if it's true or not. Many of these issues are amplified by the AI boom, as training and running advanced models requires significantly more compute power and thus resources than traditional data center workloads. Mitigation efforts like better efficiency, renewable energy sourcing, advanced cooling, or liquid immersion, and stricter siding zoning rules exist, but have not kept pace with the growth of many areas. Some localities have imposed moratoriums or heightened scrutiny due to these cumulative negatives. Overall, while data centers enable valuable digital services, their rapid expansion poses real trade offs for energy systems, ecosystems, and communities. So it's worth debate. I think this is where it's good to have a debate and friction and hear the negative sides of it. And if some of these big hyperscalers can address those negatives and make sure that where we live is actually still maintains a relatively good quality, then it's an interesting dialogue, and there might be a solution to all of it in the end. We become more advanced and as a society and as a culture as it relates to this new manufacturing boom, which we are going to probably see due to all the adoptions of all the benefits of AI on the back end. All right, what are the positives? So we already talked about what data centers are. Benefits for business and users. So if you have an iPhone in your hand, or if you work on computer screens, most of the time, most jobs are into that. So, or even in manufacturing with robotics and automation and things like that, this is a real thing. Data centers provide critical operational advances compared to on-premise servers or decentralized setups. So, centralized data management and efficiency. They allow organizations to store and manage all data in one secure, optimized environment, reducing duplication, improving analytics, and lowering overall IT complexity. Scalability and flexibility. Businesses can easily scale computing resources up or down based on demand without major upfront investments in hardware. This is especially valuable for hyperscale data centers, which handle massive workloads for cloud providers. So, cloud compute, which has been going on for a while. High reliability and uptime, built with redundant power supplies, backup generators, advanced cooling, and disaster recovery systems. They minimize downtime, often achieving 99.999% availability. This keeps services running 24/7, even during outages. So they offer multiple layers of physical security, biometrics, surveillance, and cybersecurity, firewalls, encryption, compliance with standards in the space, like HIPAA and others, far surpassing typical office setups. So that's the enhanced security element. Cost savings through economies of scale, shared infrastructure, and professional management. They reduce capital expenditures, so CapEx, on equipment and operational expenses, on OpEx, that is, on maintenance, cooling, and staffing. Hyperscale designs further optimize energy use and workload balancing. So they optimize it. Yes, they're adding more, but they are also optimizing for the future. Support for innovation. They enable advanced technologies like AI, machine learning, big data analytics, LOT, blockchain, and edge computing by providing the massive compute power and low latency connectivity required for end users. This translates to seamless experiences, faster internet, reliable video calls, secure online transactions, and access to AI tools. So, economic and community benefits, here's the positives of it. Data centers often serve as major economic drivers, particularly in regions where they are built. So, Data Center Alley, for example, in Northern Virginia, created jobs. So, construction phases generate thousands of temporary high paying jobs. For example, electricians and technicians. Operations support permanent roles in IT, like engineering, security, and maintenance, with multipliers of 3.5 to 7 plus indirect or induced jobs in the broader economy, suppliers and services, etc. A PwC study noted significant employment growth in the sector. Okay, so there's an opportunity for young folks to get jobs in that space, maybe skilled labor and others. Tax revenue and fiscal returns, they contribute billions in property sales and other taxes, often with high benefit to cost ratios. For example, $8 to $26 returned per $1 in public services in some areas. This funds schools, infrastructure, roads, and public services without proportionally increasing demands like traffic or housing. Infrastructure development, they drive upgrades to power grids, broadband, and utilities, which can benefit surrounding communities and improve overall reliability. For example, through partnerships or renewables or microgrids. Broader economic ripple effects. So they attract related businesses, boost property values, support remote or hybrid work, and stimulate local spending, for example, from visitors and suppliers. Nationally, the industry has contributed trillions in economic output. Examples include areas like Loudoun County, Virginia. Nearly half of property taxes are from data centers, or Phoenix, Arizona, where there's hundreds of millions in tax revenue. Societal and broader impacts. So, enabling digital connectivity. They are the backbone of communication. So, email, social media, video, emergency services, healthcare records, government functions, education and entertainment. Without them, remote work, online shopping, and real time services would not function at scale. National competitiveness and security. So, domestic data centers reduce reliance on foreign infrastructure, keep sensitive data under local jurisdiction, and support AI driven innovation, scientific research, and economic leadership. Workforce development. Many operators invest in training programs like STEM education and skills academics, helping locals access high demand tech careers, whereas that wasn't available as much before. Additional notes on efficiency and sustainability. Modern data centers, especially hyperscalers, are designed for energy and resource efficiency through optimized cooling, workload balancing, and renewable energy procurement. They can drive innovation in green power and grid modernization. However, their high energy and water use in some cases requires careful planning to balance benefits with local impacts. Overall, data centers are essential infrastructure for the digital economy, delivering efficiency, reliability, and growth while supporting everything from everyday conveniences to transformative technologies like AI and robotics, and then machine learning, large language model analytics, all of that stuff. Their net benefits are often substantial when paired with good community engagement and sustainable practices. That's from 55 different sources across, and these sources are legit. But that's the positive side of it, according to the analytics spun out from Grok. So went through Indiana data center boom, and then the negatives, and then we ended with the positives. So hopefully it's worth looking at investing in these companies that are also investing in these hyperscalers, as well as downstream suppliers, and they're broadening out suppliers. I think that it's going to help not only the Fortune 500 companies, but a lot of the mid cap and small cap or the SMID companies from an investment perspective. Um, but there are questions and concerns. There is friction, and so anytime there's a disruption going on and a new technology that's changing the way we're going to be living, there's always going to be friction. So hopefully we can all come together and work it all out, and it ends up being a net benefit, which I believe it to be. All right. There's a long educational piece. Hope you found it helpful, and we'll talk to you next week. Wall Street Journal article, the typical U.S. home is 44 years old and needs tons of work. Even a new coat of paint can be costly and complicated in an 88-year-old colonial. So this article was by Veronica Dagher, April 4, 2026. It's crazy, but it is true. A home construction boom sprouted across America in the roaring 1920s. Millions more single-family units went up across the suburbia after World War II. Buildings surged again in the 1970s. Now those homes are old. More recent new construction hasn't replaced America's graying housing stock, meaning the age of the median home is a record 44 years, according to the Harvard Joint Center for Housing Studies. You know, as an aside, the first-time home buyer is now at age 40. So not only are first-time home buyers getting older, but the homes that they're going to be buying are very old too and need a lot of fixing up. The typical house is well past the age when the roof needs repairs and the furnace needs replacing. The extent of maintenance and modernization needs is vast, and the cost of doing it is going up really fast because there's frankly not enough people to do that kind of work. We've got smart houses these days. Back then, I mean, they had two wire. I mean, it's just crazy the change. Mindy and Joseph Mavora own an 88-year-old colonial in Sands Point, a New York City suburb with plenty of old homes. That is often considered an inspiration for the Great Gatsby. The house is due for a new coat of paint, a task they know to approach with caution. A few years ago, they considered stripping the paint to reveal the original brickwork of the more than 3,500 square foot home, hoping to eliminate the need for future repainting. However, a contractor cautioned Joseph that the bricks would be expensive to replace if chipped during the stripping process. Even a successful process posed an aesthetic risk. A new brick next to an old brick would look terrible, said Joseph, 66. He's age 66. The cost of home maintenance, even after accounting for broader inflation, has jumped. Structural repair costs grew by about 14.1% in real terms between 2022 and 2024, according to the Federal Reserve Bank of Philadelphia. Plumbing jumped by 23.6%. The increase reflects the rising cost of individual parts and labor and the larger size of necessary repairs. This is on top of the rising costs of home insurance, property taxes, and homeowners association dues, which are making it prohibitive for many to simply own a home, not to mention buy one. So they have a chart on this article, the age of America's homes. There's a little over 10 million that are 14 years old or less. Just around 13 or 14 million that are aged 15 to 24. Just slightly below that, 25 to 34 years old. So around another 10 million or so, 35 to 45 years old. 45 to 55-year-old houses are around the same, 10, 11, 12, somewhere in there. But then there's this huge jump of homes that are aged 55 years or older. And the number that's out there on that one is almost 30 million. So like 3 times. So financial advisors traditionally suggested setting aside 1% of a home's value annually for upkeep. But many now argue that isn't enough. While 1% may cover routine upkeep, 2 to 3% provides a more realistic cushion for expected maintenance, home improvement projects, and unexpected repairs, particularly for older homes, said Angie Hicks, co-founder of the home services company Angie's List, or Angie. You're not just buying an older home, you're buying a maintenance schedule, said Brian Werner, a financial planner in Pittsburgh. He's right about that. The Mavora family expects to spend roughly $25,000 for maintenance this year, including about $4,000 for electric work and around $11,000 for a paint job. That is in addition to an about $10,000 for landscaping for the home they estimate is worth about $3.2 million. During the last repainting cycle, they received quotes ranging from $8,000 to $50,000. They said that some contractors appeared to charge a premium because Sands Point has a reputation for being affluent. They get at least 3 estimates and ask for recommendations from neighbors. That's how you should go about it. Joseph said that their annual spending fluctuates based on the work that needs to be done. They have spent as much as $100,000 a year in repairs and maintenance and as little as $10,000. Even budgeting 3% of the home value for maintenance might not be enough by the time the project wraps up. When you're starting a project in an older home, you just have to expect costs overruns. And usually it's like 20 to 30%. You got to kind of put in as a buffer on overruns because you just don't know what's going to come up. During a bathroom remodel about 9 years ago, contractors discovered concrete between the wood in the frame of the house. The project's costs skyrocketed when plumbers had to perform an expensive workaround to bypass the concrete. To avoid surprises, Mavora has invested $2,500 annually in preventative maintenance for their Vermont slate roof. For all the costs, their home is quite durable. During Superstorm Sandy in 2012, a tree fell onto the house, but the structure remained intact. A contractor later told them that the sturdiness of the house likely saved it from being crushed. Many owners find that aging features, even cracked driveways, can cause insurers to raise premiums or drop coverage entirely. A deferred repair can become a mortgage default risk if a homeowner can no longer meet the lender's insurance requirements. For condominiums, Fannie Mae and Freddie Mac blacklist buildings with significant deferred maintenance or thin reserves. This can render units unsellable to most buyers. 49% of all improvement spending is now for the necessary replacements like HVAC that owners can't delay, said Rachel Drew, director of Harvard's Remodeling Futures program. The financial burden is particularly heavy in regions like the Northeast, where homes tend to be older. Let's see, in 2023, homeowners in the U.S. spent an average of $9,030 on replacement projects such as windows, up 59% from 2009 after adjusting for inflation, said Harvard's Drew. The Mavoras have stayed in their home for 29 years, though they have listed it for sale twice. They recently toyed with the idea of moving back to New York City, but they would likely pay significant capital gains taxes to sell the place. What's more, they would be losing their almost 2-acre backyard. They have a pool that could be a draw for future grandchildren. They purchased the home for $765,000, and there wasn't significant deferred maintenance when they moved in, though they figured they would have to buy new windows eventually. Since then, they found that if they didn't use all of their repair budget in 1 year, they were likely to exceed it the next. The Mavoras tend to give priority to keeping the home in good shape long term instead of taking the cheapest option. When replacing their copper gutters a few years ago, they considered switching to aluminum, which would have been cheaper, but ultimately stuck with copper to preserve the home's integrity. After all, they expect to be there for many more years to come. So there's a lot that goes into that, into home ownership and leveling up and keeping the home in good shape. And the majority of homes out there are almost nearly 30 million of them are 55 years and older. So when you go to buy a house, make sure you get good inspections and be ready with some extra cash flow to help upgrade the core components of the home. All right, there you have it. Hey everybody, I came across this really good article in the personal finance section of the Wall Street Journal, and it is worth listening to. Very interesting. Come across a lot of this stuff. So I hope you guys enjoy this bit. The complicated financial lives of dentists, the millionaires next door. They have high incomes and valuable practices, but start their professional lives playing catch up, a challenge for the money manager chasing after them. Okay. And this was a March 26, 2026 article by Miriam Gottfried. Really appreciate the work there that she does at the Wall Street Journal. So, among America's swelling ranks of moderate millionaires, few have more complex personal balance sheets than dentists. They earn high incomes, have built valuable practices or businesses, and have benefited from the rising stock market of the past decade and a half. But they often graduate with significant student debt and spend years tying up money and building their practices. Dentists are emblematic of the moderate or mid-tier millionaire. U.S. individuals with $1 million to $30 million in investable assets, whose wealth rose 52% to $20.2 trillion between 2018 and 2024, according to the consulting firm Capgemini. Unlike their richer counterparts, many of whom have generational wealth, moderate millionaires often finance their rising expenses themselves, hindering their ability to invest and save for retirement. Entering their professional lives in a financial role often leaves an incredible mark on the ways dentists invest. Some take on risky, self-directed investments, while others are forced to minimize their retirement savings until they pay off their obligations. Some forego traditional financial advisors. There's a bit of a misnomer that, oh, you're a dentist, you must be doing exceptionally well, said Don Calcagni, Chief Investment Officer of wealth management firm Mercer Advisors, where I actually used to work. I got my start out of college working at Mercer in Santa Barbara, California. Let's see, he said, he got his start managing money for dentists in 1985 and still counts many among its clientele. This case study happens to be about Dr. Sunny Palja, graduated from dental school with about $250,000 in loans in 2011. With student loan burdens now sometimes topping $500,000 or more for dentists, and interest rates at 6% to 8%, paying off student loan debt is often the best use of their money. A newly minted dentist earns around $150,000 or more, but student loans eat up a lot of their take-home pay, especially in the early years. After a 3-year stint as an employee, Pulja did what many do. He bought a Cincinnati practice and the building that housed it, taking out a $1.5 million loan. Those building practices from scratch are typically borrowing $3 million to $3.5 million, according to Lindsay Harkey, head of healthcare financing at Wilmington, North Carolina-based Live Oak Bank, which lends to a lot of dental practices. Costs are rising for everything from construction to hygienists to new 3D imaging equipment. The median general practitioner dentist income fell 13.2% in inflation-adjusted terms in the 5-year period that ended in 2024 from the prior 5-year period, according to the American Dental Association Health Policy Institute. Wealth managers prowl dental conferences for prospective clients, but more than 18% of dentists don't work with any kind of advisor, be it an accountant, financial planner, investment advisor, according to a 2025 to 2026 survey conducted by Incisal Edge, a dental trade publication. Among American millionaires more broadly, 26% don't work with a financial advisor, according to a 2025 study by Northwestern Mutual. Pooja is one of them. Now 42 years old, his annual salary is in the mid-six figures. He owns a number of rental houses, and his investment portfolio, including retirement accounts for him and his wife, is in the millions. He doesn't see the need for an advisor, even though local representatives of Morgan Stanley and Merrill Lynch have tried to woo him. He doesn't answer their calls. If it's really important, they'll leave a message, he said, who also runs a Facebook group where more than 26,000 dentists swap tips for maximizing practice profits and using backdoor Roth IRAs. So obviously some investment strategy there. Wall Street's courtship of moderate millionaires has intensified, with firms like Blackstone and KKR looking to them to fuel their next leg of growth. They are introducing more products aimed at individual investors, such as private credit funds. But such alternative investments often require tying up a lot of cash, which dentists typically can't do at the beginning of their careers. Many private credit funds are now limiting redemptions because too many people want out of them. Eli Engler of Ashland Advisors in Atlanta said that when it comes to younger dentists who own practices, he favors stocks and bonds. I don't look at alternatives until someone has amassed a significant amount of liquid assets, Engler said. Husband and wife periodontists, doctors Munish Bola and Shilpa Kolhatkar, own 2 practices in Detroit suburbs and are wealthy enough to meet regulatory requirements to invest in more restricted kinds of alternative assets, meaning they have at least $5 million in investable assets. They have long worked with a financial advisor, but it wasn't until they were both around the age of 50 that their advisors suggested they start investing in alternatives, a category that includes hedge funds, venture capital, private credit, and private equity. Quote, "We started off with index funds," Bola said. "At this stage, once the business has grown, our risk tolerance is much higher," end quote. Dentists' average age of retirement rose to 68.7 years in 2024, according to the American Dental Health Policy Institute. That is older than the typical retiree. Practice owners often try to catch up when it comes to saving for retirement by using tax-advantaged savings products like cash balance plans, which let people save millions of dollars on top of a 401k. Many dentists don't save enough and will run out of money when they sell their practices, according to Chris Sands, a partner at Profi 2020 Dental CPAs, a Suwanee, Georgia-based accounting firm that serves dental practices nationally. Instead, Sands sees them loading up on Bitcoin, backing niche dental technology companies, and pouring money into questionable real estate ventures. A lot of dentists want to throw a dart and hope they hit it rich, Sands says. Dentists' reputations for being maverick investors have made them targets for unscrupulous actors. Many have lost money to multifamily housing syndicates and investments that turn out to be scams. Pulja got tangled up in one ill-timed venture. He invested $250,000 in 5 multifamily housing deals between 2020 and 2022. The deals were pitched by Ascent Equity Group, a firm founded by a Boulder, Colorado physician whose website touts passive real estate for physicians by physicians. When the Federal Reserve rapidly raised interest rates in 2022, the properties became distressed. Pulja expects to lose 80% of his investment. Ascent didn't respond a request to comment to the Wall Street Journal article, but it was a big lesson learned on my end, he said. There were a lot of things we just didn't see coming. So there's some warnings in there. You can hear them. And then also there's some advice about working with a financial professional can help you, but do your due diligence, pay attention, ask a lot of questions, and try to be your own advocate as you do with being a patient in healthcare. Also, as a business owner, a lot of dentists went to school to be a dentist. They didn't go to school to necessarily be a business owner, and a lot of dentists find themselves having to make a whole plethora of decisions on the investment front and on the business front and running practices and multi-practices that they often need help when it comes to consulting and making wise and prudent decisions. All right. Hopefully you found that interesting. Maybe there's a few takeaways in there for you, even if you're not a dentist. Thanks for listening to the Northbound Wealth Podcast.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.